This is Rod Kusin and Spooman for Risk on December 1st, 2009, all times on the Charter Central Standard Time. Today we're going to look at two Pro Trader setups based upon the use of the premium and the VIX. On the chart we have a 1-minute chart with our three different premium feeds, the S&P, ES, and NASDAQ Premium. If you're not sure why we're plotting the bars as we are on the chart, go to our website, RSKsys.com. Read the section on the premium. You'll find out what our rules are. So the two setups are very simple. Now the first one we didn't take, but take a look at this. We hit a new low on all three premium feeds. Correspondingly, we have a new low on the Spoos. That tells us that the Spoos will likely drop below 1104 based on new lows on the premium. So the setup would be, if we don't drop below very soon, look to short the market. We get that opportunity as the Spoos move up into new highs. But at that time, we hit new highs on the premium, indicating that the Spoos are likely going to go higher. So now it's a question of, well, what are you going to do first? We chose to wait. But certainly, those who chose to short the market and look for a new low could have easily made 3 to 4 points as the next 1-minute bar dropped to 1103, right over here. In our case, though, we're looking for an opportunity to go long and ride that up until we hit the premium target of 1108. The question is, where are you going to get in? You could have a variety of different methods for doing so using technical analysis. We use two different methods. One is divergence, okay, and one is the moving average. It's very simple. Now let me show you what I mean. Here's the 1-minute VIX, and what you see here, this yellow curve is a simple moving average set to 9. You could set it back a little bit more than that if you wish to. The best entry would have been obviously at the low. But how could you call that? We'll show you in a minute. Another way is to wait for the VIX itself to drop below, to close below the simple moving average. That happens right here on that bar corresponding with that high on, that bar on the Spoos. Now we're going to show you another automated trade that takes a trade here that could have easily gotten stopped out. And notice what happens right in here. See where this bar is? The close of the bar is way above the simple moving average and doesn't drop until here. Here's a nice safe place to go in. This is very risky. Now we use a divergence formula using a DPO to tell us precisely where the divergence takes place with the VIX. Now you'll see on this automated chart two single bars painted, one white, the other blue. White corresponds to divergence on the ADS-PD. Blue corresponds to divergence on the VIX. I like the VIX. So on this specific 100 tick ES bar, that's where the divergence takes place. That's our long trade. You are on this particular bar, the low being at 1102.25, the low here 1102.50. Okay, that bar is formed based on divergence that's taking place 1 tick below, or pardon me, 1 tick above the low. That's pretty precise. And the automated system rides you right up until we get divergence again on the VIX using the yellow colored bars. That also corresponds with 1108.25, 1108.50 for an exit. That's all automated. That's pretty nice. Let's look at another strategy. In these two instances, here's the trade that takes place before the low, where the close of the VIX bar was way above the moving average. Obviously, Spoos moved down. But here's the more safe trade, automated, corresponding with the low of the Spoos dropping below the moving average. Very safe and still plenty of room. Ride it up until the predictive power of the premium is achieved. That's a nice 4 to 5 point move, depending on where you get in. That's a good pro trader trade. Okay? Now we're going to take just a couple more minutes and go back to the VIX chart. Now let's take a look at that rule that we were talking about before. If the close of the VIX is dropping below the moving average, look for an opportunity to go long. Now you have that happening first here, where you were above, then you drop below. It happens again here, and then conceivably right about in here. Now, this doesn't get you much because we drop above again over here. But notice on this bar, right there, you're dropping below the moving average. It corresponds to this bar here and a nice trade. Even if you got filled at 1108, you're running that up to 1109. Okay? Another opportunity to go long here or here, right in here, or here. Okay? Now, those few entries didn't go very far until this entry here, right? Pardon me, let me get that back. Right there. The low below the moving average. And look at that run. That run takes you very nicely from roughly 1108.50 all the way up until it closes right in here at 1111. Nice trade. You see that happen all the time. Now, there's a lot of ways to refine those trades beyond what we just said, but this is very simple, and yet very, very effective. So we invite you to come to our website, RSKsys.com. Scrutinize our website. Now, we're trying to improve on it all the time. We've got more content that we'll be posting in the days ahead. But pay particular attention to the bars on the left-hand side of the page and examine our subject on group reversals, the premium, divergence, gaps. We use all of these different methodologies in coming up with a variety of different effective strategies that consistently work every day. Then ask for a demo. We'll spend an hour or two with you privately to answer all of your questions, and then we'll schedule you for a live demo where we actually put into practice the things that we have taught to you in our first demo. But above and beyond that, take our course. It is well worth the money. It's not cheap. But when you can abide by a slogan that we have successfully achieved, never have a losing day. Never have a losing day. There's no reason to, not when you have the right tools at your disposal. And you can succeed. So we look forward to hearing from you. I'm Rod Kusin and Spooman for Risk.